Are you earning a solid income but still unsure how to build lasting wealth without burning out, or living a lifestyle that doesn't interest you? If your business or T4 income is thriving, maybe you've been testing real estate waters or building your confidence in investing in the stock markets, then this episode is your playbook for turning income into sustainable, tax-efficient wealth. Listen in as we speak with Canadian Wealth Secrets longtime listener Brad. And Brad is here to share his journey from working 6 to 7 days a week in his business, generating $30K per month, and then figuring out what do I want to do with those profits, and been dabbling in real estate investing. So Brad is often unsure, and here are some main questions we're going to answer with Brad in this episode. Should I buy future properties personally or through my corporation? How can I use profits from my business to fund new assets without getting hammered by taxes? Did I make a mistake keeping my rental properties in my personal name? When should I think about insurance as part of my financial strategy and not just protection? So we're going to dig in with Brad here. So and stick around to the end. We're going to be unpacking Brad's kind of overall financial health audit and his financial health system using our 4 stages for wealth journeys. So stick around to hear Brad's report card.
Tell me more about your day trading. Like how long you've been doing that for and what's going on there?
I guess I'll go back a little bit. We bought a couple properties, rental properties, and they're doing well. We've had them for just about 3 years. Well, one of them, the other one, 2 years. And then we were kind of like, let's keep this rolling. And then we kind of got that analysis paralysis and was like, man, are we over leveraging ourselves? Like, we don't really have any systems in place. We just kind of flying by the seat of our pants. So I started looking into like financial literacy, like training kind of mentorship, and I came across I think they were out of Ontario, called Trust Your Talent. They're like a real estate coaching mentorship. And so we started the courses in December. So there was the NASDAQ futures, and then we also just started trading with gold as well. So yeah, so far, we've profited just over 30 grand each month. So that money, we took a couple $100,000 out of our HELOC and put it into we formed a corporation for this. And then we've been paying that 30 grand back to our HELOC from like the shareholder loan, I guess it was called.
Yep.
So we're kind of, if things continue down this path, we're going to be, all of our borrowed money paid back a lot faster than I anticipated. I didn't anticipate to make this much profit. So I'm kind of just trying to get a kind of a path forward, like looking down the road a bit into the next couple of years. If we do continue to make this kind of income, how we can better serve ourselves with it, keep buying assets.
Yeah, well, good for you. That's awesome. Glad to hear that it's going well. And it's one of those I always suggest to folks that are like active trading and so forth. Just sometimes it can be hard to go, okay, set myself a timeline. No, don't try to scale up too fast or too aggressively. You know what I mean? Yeah. Just to, kind of get that consistency going. And as long as you can kind of keep that, that sort of, mindset going, then at least you'll, kind of protect yourself from, who knows, right? The markets are a finicky thing, but it sounds like you got a good system going. So good for you both.
And the margins, like that one point, with this strategy, with all the volatility with Trump, it actually creates more money for us. But At one point, you have to be able to put in a couple, they say 3-to-1 on your reserve fund. So when the margins start to climb up and you get over leveraged, you got to keep adding money into the CMC trading market account just to keep yourself from if your margin levels drop, then they liquidate everything. And we don't want to have that happen. That's when things go bad. So
Sure. Yeah, you want to be able to stick in even when things get a little dicey, right? When things get dicey is when usually the margin calls start and so forth, right? So as long as you're on top of it, right?
Yeah. So that's kind of where the trading started or came from. And so far so good with that. And I guess part of this is just kind of understanding if the trading account should be separate from everything. Because I guess back to your point, my accountant kind of grounded me. She's like, so I'm like, oh, I have a business now. Like I can start writing off, all these expenses going for lunch. And then with the day trading, there's none of that. I can't really claim anyway, because I had all these big dreams and then she shut me right down and brought me back to reality pretty quick.
Is your accountant feeling like the day trading is active? So it's going to be considered active income?
Yeah. And that was the other thing, because I have a well-established decent paying job that I was, and everything I was reading was like, maybe I could claim as capital gains, but I'm doing, a couple hundred trades a day, this strategy. So she's like, no, that's active income, not capital gains. So
yeah, well, it's actually better to be that way as long as you're incorporated. So obviously, it wouldn't be super helpful if you were doing it at a personal level. That was my big question in my mind, was just making sure that, your accountant's feeling like the number of trades you're doing is active. Because if you went to a corp and let's say for whatever reason it was passive, it's actually not going to be helpful to you at all. It'd be, quite a high tax rate. If it was capital gains, you'd be kind of halfway between both. Yeah. And then of course, active is fantastic now. So that's great. So I'm glad to hear that, it's considered there's enough. I mean, heck, if you're doing hundreds of trades a day, then, obviously, CRA is going to be going like, oh, okay, that's clearly fairly active here. So that's a good thing. So good for you guys. Yeah. I like the way you're structured. The nuance on the back end, as you probably heard in some of the episodes, is like, it's all good and bad, right? It's like when I earn it in the corporation, I get tax deferral on that, because really what it is you're going to pay your 10 to 12-ish% on that active income, which is great. But then as soon as you take it out personally, that's where essentially you're kind of undoing all of that. You're taking it on personally and then going into these higher brackets. So then it becomes, okay, now what do we do with all this money? And usually what that would mean is, we take that money and then we put it into other assets inside the corporate structure, right? So not sure if that's sort of maybe some of where your mind's at right now is like some.
That's where the whole focus is.
Yeah. Okay. Perfect. Yeah. Perfect. Yeah. So you've got the one company, the properties you own are personal, right? I believe.
Yeah. No, before we opened the corporation, we talked to the accountant, and because of our high tax bracket, the first year, like when we were doing the underwriting, we weren't going to be very profitable. We were going to be just breaking even on the cash flow.
Yeah.
So we decided, to keep them in our personal name originally, like currently. And then, last year we had a rough year with some damage to one of the suites and the tenant with loss of rent. So we were short, like our cash flow was like $8,000 on one of the properties, which we were able to write off against my personal income. So for that reason, so that's why those are in our personal name still.
And honestly, I'm the type of person, it's like when you have, it's like having some assets in my personal name, even if sometimes in some years, maybe you might lose a little bit on the income side. But the reality is that if you own those properties in the corporation versus out, you're still going to be paying, you'll be in the highest tax bracket in the corporation, not necessarily personally. So I would argue keeping them out is probably going to be, from a tax perspective, the better move over the longer term. If let's say they're ever fully paid off and you don't remortgage them, let's say you just were taking this income, remember, same result would happen in the corp. You're going to lose 50%. Personally, you may or may not lose 50% because you may or may not have a T4 job at that time, right? You might choose to work less, or you might choose to, full-time day trade in the corporation, and now you can control your income. So I like it, to be honest. I actually think it's a good move. And I think a lot of us investors almost think like it was a bad move. I get a lot of people calling saying like, hey, should I move it into the corp? I feel like I made a mistake or this or that, but I actually really like it. And I think having those assets there, especially down the road when, let's say you want income and you want to borrow it instead of say sell in order to get more income or to get a chunk of money, that's going to put you in, I think, a really good spot.
Okay, well, that's good to hear.
Yeah.
The only thing my concern would be is like we're going through these courses, and part of the next step is like actually going out, taking some action and buying some more properties. Now, the ones we're looking at are a little bit larger, like multifamily, like 5 to 10 units.
Yeah.
Which in the corporation, they look at the property as its own business and its operating income and all that. That's based, for most of it, I think that's how you get approved. But is there like down the road restrictions on borrowing power for me personally if I buy more properties in the personal? Because I keep hearing like 5 properties is kind of the cap for people personally.
It's somewhere in the range of, I would say, 4 to sometimes 6. Every lender's a little bit different, but I would argue though, like you're now entering into this place where you're going to start having this money, quote unquote, trapped in your corporation or in your structure, right? So you have this active company, great. If you buy more property, you probably, so you've already got a couple personally, great. Because now you have money that was earned in the corporation, those dollars should be probably reinvested in the structure. You don't want to take money out personally, get hammered in tax, and then try to reinvest those dollars. So in a way, the timing sort of suggests that I would say this next property you buy probably does make sense to do in the structure, right? Because now you've got money in there, and again, you might still owe yourself some money, like maybe it's not all profit right now in terms of retained earnings, but as you keep doing that, you're going to have more and more money stuck in there. You're going to want to reinvest it in there. So you might want to open up, let's say, a holding company where you could buy the property. Money can travel between those two corporations without any sort of tax. As long as it doesn't come out to you personally, you're not going to take on personal tax. So basically, like that would be in my mind. And then now you also open the door, like you had said, that now the property is considered a business. They're going to underwrite it like it's a business. Like, is this thing profitable or is it not? Your debt service ratio is going to be, probably 1.25 is what they'll probably look for with traditional financing. Maybe it's 1.1 if you do CMHC, MLI Select, if it's more than 4 units and it's residential. So you'll have a lot of flexibility there. So in a way, I feel like, you're kind of setting the table pretty nicely right now to go, all right, more and more income in this corporation, probably a good idea to do that next one in a corporation instead of say in your personal name.
Yeah. And then, so like the property we bought it in the corp, and then the mortgage, because all of our mortgages convert to lines of credit, those step mortgages that we have. So if we had the same setup for, say, this, we'll call it a new property, the earned income from the day trading, I can use that money to pay down that mortgage as long as it's in the corporation.
Exactly. Okay. So you could do that. Now the negative of doing that is, like, obviously you're losing a write-off, right? So you're losing, some of that interest to write off. So the faster you pay off the mortgage, the less expense you have, So in a way, if those dollars, like, let's pretend every dollar earned inside this corporation is sort of money that you're not planning to use personally for some time. I'm guessing that's probably the case, unless you want to quit your job tomorrow. Assuming that's the case, I would probably say there's no rush to pay off the mortgage. It's quite the opposite. You want to keep the mortgage, let it do its thing as slowly as possible, write off interest as normal, and then any additional cash flow you want to put into other investments as well. So you get kind of the double win versus, say, making debt equity on an investment property. Right. In a way, you want to keep that equity out. You want to be able to, take that money and put it into other assets and essentially stay as liquid as possible. I know you're opening up a line of credit, which gives you flexibility, which might feel good to know just because, you don't have, let's say, capital sitting there burning a hole in your pocket. But I would argue that, those traditional mortgages and just, I would say, slow and steady on those is probably going to be a better bet given inflation, right? So the debt's worth less and less every day. The write-off, the rental income is going to be taxed at the passive income rate in the corporation. So in a way, you're going to want those write-offs so that you're showing less profit on those properties.
What's the passive income rate for a corporation?
So every province a little different, but basically the lowest is Alberta, which combined is going to be 46%. The highest is, I believe it's Ontario at like 50.17 or something like that. So it's basically, like, in your mind, you can pretty much expect whatever the highest tax bracket personally in BC is, the passive income tax rate's around that number. And it's done by design, right? Like, it's the government basically saying, listen, if you're making money actively in a corporation, you were taxed at a low rate. The reason you were taxed at the low rate was because we're trying to help small businesses. But if you've got all this money sitting around and you're buying assets in the corporation, they're saying, well, I guess you're not that small of a business. So they start to really, really hit you hard. They're saying the reason you kept it in the corporation is because if you take it out, you're going to get taxed at the highest level, which you would, right? Because you're like earning a lot. So you add another 100K to that a year, or 300, or whatever it is that you're earning in the corporation, you're in the highest tax bracket. So they're like, well, if you're going to invest all that money, we're going to tax the profit on that money at the highest tax bracket. So that's sort of the arbitrage that you're trying to create. You're going, okay, if I wanted this corporate structure to be like a wealth generating machine, I want to defer my personal taxes as long as possible, hopefully forever. And then I want to create more and more assets, but I also don't want to rush to have too much profit showing, or really rental income is essentially a passive income. Whereas capital gains,
Okay.
you can let them ride, so if you buy the building and let's say you're a break even for the next 30 years, you don't pay $1 of tax. And when you sell the building, there'll be a capital gain, of course, right?
Yeah.
Honestly, I think you've got a really good thing going on here. I love the idea you can still, let's say on this next property, if let's say there's not enough profit in the corporation, you could still lend from your personal HELOC or the investment property HELOCs, lend shareholder loan to the company, and then get some of that back, over time, whatever it is. So all that would still be, the same. At a personal level, like your income's high enough that even your spouse is high enough that it might still make sense if there's extra money in your life to fund some RRSPs just to get some tax back. That way you have a little diversification of where your assets are.
In my RSPs, so after reading Rich Dad Poor Dad, I kind of gave up on my RSPs.
Sure.
And I've been just focused everything on alternative investments, real estate, the day trading stuff. I just moved, I had just over 200,000 in my RSPs that I moved into Olympia Trust, and then through them into a build to rent private equity, like limited partnership, real estate venture in San Antonio. Now my RSPs they're still in my RSPs, but they're now in a different investment. And that was part of the other reason, because when I was listening to your guys' podcast and then I'm starting to do these courses, and they always have like your power team members, and they always talk about like a wealth advisor or some sort of financial planner. But in the past, my financial advisor was just like someone solely based on my RSP account.
Sure.
They would manage that, and I would check in with them like twice a year. But I guess kind of what I'm looking for, hopefully with you guys, it would be someone that kind of has a full understanding of everything that we have, and just making sure everything's kind of going in the right direction.
Got it.
It's kind of what I'm looking for.
Gotcha. Yeah. And you know what? That's something that how we typically model what we do and the clients we work with. First and foremost, we try to be as helpful as possible to everyone in the community, meaning anyone who reaches out, we try to, make sure they get some next steps, some confidence, kind of with what they're doing. What we typically do is we'll work with them, and really, I'll call it, it's fair, I guess it's informal. And then hopefully at some point, as you progress down this path, typically you'll notice one of the main strategies that we utilize ourselves is leveraged insurance strategies. And typically what ends up happening is as you build, specifically those who have investments or businesses and corporations, you'll eventually need to have permanent insurance built in. So we do a lot of structuring of that. So we'll actually do that. And then that way we actually don't have to charge anything to anyone for any of this advice. So we just hop on calls as often or as little as people are after. And then sometimes people are going to require that extra help in order to set up a structure. Other times they're not going to need it yet, but typically people on this path will eventually need it. So that's sort of been our model. So we don't actually have, we have a lot of people asking, they're like, we want private, or one-on-one mentorship, or we want group coaching. So we're actually starting like a group coaching sort of experience, and we're just going to open it up completely free to the community. So it'll just be something we do once a month, once every 6 weeks, something like that. So that is coming. I wouldn't say like at this stage, you're at a place where, you necessarily need to rush into like into a leveraging permanent insurance sort of structure.
Yeah. Good life insurance, like term life plans right now.
Awesome.
That we just renewed for another 25 years earlier this year.
Awesome. So like, assuming that those death benefits that are there are enough to sort of make up for the shortfall of income for either spouse. And we'd say over like, I would say a significant period of time, you guys are still pretty young, let's say over the next 15, 20 years. If that's a big enough death benefit, it's probably all you need at this point. Once you have so two things. Once you start having money, quote unquote, trapped in the corporation, which you're not far off from having, by the way, right? Like assuming you continue to trade and everything goes well over this next year or two, you're going to fairly quickly find yourself in a spot where you go, now what do I do? How do I get this money? Like, what do I do with it? Or how do I make sure that when I'm ready to get it out, that's where like a leverage strategy, a leverage insurance strategy might make sense. Who knows? Maybe down the road, you have more than two dogs as dependents and, those sorts of things start to come in. But I would say like right now, I don't see like a need for it. The only other aspect would be there are sometimes people would come in and they go, I want to get myself prepared for that journey. And sometimes people kind of, start the process a little bit early. But yeah, I feel like you guys are in a good spot. You've got your term. You both got good jobs. It looks like good income. So it's not like any of this money sort of needs to come out anytime soon. Yeah. So I would say you got a little bit of time, over the next handful of years to kind of hone in on the trades, the next property you're taking. And then as that, I would say probably after that happens and, you start to gain a little more momentum from there, you might find yourself now asking the question of like, okay, now like, what's the next step? How do we make sure that when we're ready to take this money out, we're not going to get taxed in the highest tax bracket, down the road, right? Would you say based on, and I think your wish here was just kind of like, that overview here, how are you feeling from today's call? Like, do you feel maybe some affirmation about some of what you're doing? Is there any other questions maybe still circling around that you're, hoping that we were able to dig into here today? And then I guess, what would be your next step, along the journey here?
Yeah, I think, well, the big one for me was just understanding the next couple properties, because I think that's the next two steps. The day trading stuff is pretty passive. Like there's an AI bot that does the trading. So, I check my phone to make sure the script's running in the background, and I kind of leave that alone and then make sure we have reserve funds in case we get over leveraged. I got to send money into the account fairly quick. So my real focus, as long as that's all going as it should, is just acquiring a couple more properties. And it was understanding personally or the corp, which I think you explained fairly well. And then just confirming that I was able to use the income from the day trading to fund, if I need to, anything for the next property or two.
Love it.
And then trying to get those cash flowing and paid down to a point where if I can use that, whatever I've paid down in the next 5 years, take that money out and buy a second property and kind of grow it like that.
And I would also say too, I meant to comment on this before you just triggered it in my memory. The RRSPs to date that you've put through Olympia Trust, that's a great move, especially if that's sort of the asset class that you want to be heading into, like, into other alternative investments and so forth. So continuing to take advantage of RRSPs only because you're specifically in a really high tax bracket. If you don't need all that 240-ish or whatever it is that you're earning, it's not a bad move to get some in there just to get some of that kickback. And then that kickback, you can decide to do whatever you want with it, right? You send it to the trading corp or into a tax-free savings account. I'm a big advocate for real estate first, alternative assets as you're doing, like doing all of those things. But then as you're getting those wheels turning, not to permanently ignore the registered buckets. I think sometimes we go all in, like we're encouraged by maybe some of the books we read and stuff to go, it's like real estate or bust, or it's, this or bust or whatever. And it's like, what? I say promise, I can't promise. I feel very strongly that in 20 years from now, when I, am ready to just kind of pull income from wherever, I'm going to be happy that I have more than one bucket to be able to kind of draw from, instead of it all being like, one thing. And it's like, imagine if maybe, something changes down the road and I go, oh crap, I went all in on this one thing and maybe something changed. I don't know. So I like that you've got some RSPs, and I would say, yeah, keep adding a little bit there. And because you already know about Olympia Trust, you do have access, you don't have to hand them off to RBC or, whoever was investing for them for that money as well.
Awesome. We'll be in touch.
All right, my friend.
Okay, so now let's dig into looking at the Canadian Wealth Secrets financial health report for this longtime listener. Kyle and Brad here discussed many opportunities, many things that they're strengthening, many of the things that they're working on. Answered a lot of questions in this interview, this coaching call. So let's unpack, say, the 4 stages for every financial health system. So just as a recall or a reminder here, the stages are: stage 1 is designing your vision for freedom. So this is your goals, being clear on where you're trying to go. Stage 2 is establishing your corporate or your personal wealth reservoir. This is your access to capital. This is your access to emergency funds. Having that is essential for a healthy system. Stage 3 is optimizing wealth plans with structure. So are we using RRSPs, tax-free savings account? Are we making sure that we're making use of the available structures we have opportunities for tax efficient strategies. And then stage 4 is legacy and estate strategy. Are we planning for optimizing the value of our estate today, but also making sure that we're passing it on and making sure that we're not, say, passing it on and losing a bunch of that to tax. So structuring, in optimizing the estate that as it will pass on, but making sure that we're using the value of your estate now. So those are the kind of the 4 areas. Let's just quickly go over Brad's kind of report here. Now, in the first stage, which is designing your vision for freedom, we're going to give Brad a B+. Like, he's got clear aspirations for passive income. He's been looking at different asset classes. He's got, his business income. He's got his, he's looking at investment. He's got strong financial literacy, kind of protecting him in certain areas. But say where he needs to get an A is he needs to basically clearly articulate, like, what does the long term look like, and what does the end goal look like? Like, where is that position of making contributions and looking in your years of gain and in your years of like adding to your pile, and then where do the years look like of, say, using that pile, and where does that transition into? Like, where does that transition time happen, and do we have a clear pathway, like a structured pathway with certain asset classes, with trajectories, which means we've extrapolated the data to say we're here and we want to go there, and then we have a number. Brad needs to kind of know what that number is and then structure that pathway to get there. So we didn't hear that in this call. So this is why he would get, say, a B here. So you get an A when you have that clarity of where your numbers are and where you're trying to get to. And are the asset classes that you're contributing to now, if you project that out, will it get you there? And I think this is the part that you need to have. So stage 2, we're going to give him an A- here. He's establishing his corporate or personal wealth reservoir. He's got an effective use of his corporation, so he's making sure his business is, say, performing well in there. He's been talking about passive income inside there versus active income. He is understanding some of the dynamics there that are needed to make sure you're maximizing those components. But I think he needs to also formalize a system for intercorporate lending between his companies, making sure he's tracking those things, but also does he have access to capital using his rental properties, using his corporate structure? Do we have some of those reservoirs that we're building up inside there? We didn't hear a lot of that here today, so there's some improvement there. Stage 3 is optimizing your wealth plan. He's actively investing in real estate, exploring tax shelters. He's got a mix of RSPs and alternative investments, so that's great. He's been looking at evaluating different capital allocation strategies, so that is good. Some of the moves he could be making is thinking about optimizing those registered accounts. Are we making sure that we're, say, maximizing our RSPs, but also our tax-free savings account? And do I have access to, say, some structures that could be? Now, you heard Kyle and him talk about it. They're making some headway in this area, and he didn't feel like, say, using a tool like a high cash value whole life insurance policy was at this time needed for what he's trying to do. It's not always needed, but it is something he's probably going to need in the future because it can optimize for your wealth plan here and in taxes, especially as you go into stage 4, which is your legacy and estate strategy. Also gives you opportunities for your wealth reservoir, which is stage 2. So we talked about that. It's not really a great fit for him just yet. We want to be making sure that we're optimizing some of those RSPs and tax-free savings account structures first. So he's getting a B+ in that area. Stage 4, he's going to get about a C, which is natural for his kind of like thinking, but I think we can always do better on stage 4, which is kind of going, we know we're trying to plan for long term. Like you heard him talk about a term life insurance, and it felt like it was a good use of covering his income, so that if he did pass, we've got that covered. But there is also no current estate plan or intergenerational wealth strategy being discussed on the call. So either he has it and we don't know about it, or we're not sure he hasn't planned for it. So we're going to give him a C+ here because there is some work to be done there. So overall, Brad's got a strong financial position, active cash flow, successful, business, foundational real estate assets. Those are some great fronts there. But he's also got some next steps to think about, some optimizing those 4 areas. So overall, he's kind of like B+ area, which is a great spot for an entrepreneur. So if you also want to know about your, say, pathways or your stages, head on over to CanadianWealthSecrets.com/pathways. You can fill out our survey there, and we can help pinpoint which of those zones or which of those phases you want to start with, or you want to say optimize for, and we'll give you some next steps along the way. So again, that's CanadianWealthSecrets.com/pathways. Just as a reminder, the content you heard here today is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Kyle Pierce is a licensed life and accident sickness insurance agent and president of corporate wealth management with Canadian Wealth Secrets.